A lot of the numbers have come down. Energy's come down. The price of the pumps come down. Travel's come down. Used cars come down. I mean, what more do we need?
Ah, yes, folks. Today, the stupidity meter that represents the psychology of us apes aimlessly running around the market trying to figure out the economic circumstance to continue printing them tendies has returned to a neutral rating as the information has finally come from the horse's mouth. The Federal Reserve's own Jerome Powell claiming inflation's dropping off. CPI inflation rate eased to 8.5%. But damn, it didn't take an analytical 10-year Harvard degree analyst to realize that, hey, you take a look at things like steel, you take a look at things like wheat, these global economic exports, and the one that's causing it all, of course, fuel, gasoline, all trading down over the last 2 months, finally driving the stock market out of its kind of bear market territory here. We're only down 12% on the year so far, but is this a bear trap? Because damn, you listen to people like Peter Schiff, you run around these markets and all these analysts are claiming all this money printing, all this calamity is going to lead to the greatest bear market in human history. The likes of Michael Burry saying we're still going to see a compounded effect into the earnings season, and earnings didn't end up being that bad. I mean, even on the Canadian side of the board, we're only down 6%. So it's kind of imperative to understand a strategy where you're not being manipulated by these analysts. And I mean, it's really hard even today on TikTok, right? You go back literally barely a month ago and you would have heard a lot of TikToks reminiscent to this.
You cannot fall for this bear market rally because it's going to get a lot worse before it gets better. Bitcoin recovered by 20% while stocks recovered by 7%, but this is due to the markets being oversold and the sellers are taking a breather before another move down. Nothing has changed fundamentally with the markets. Companies are still getting bankrupt and liquidated, the Fed is still hiking us into a recession, and inflation continues to get worse. Until we get good economic news to create positive market sentiment, do not go all in at once, but be conservative by buying bits and pieces of this market dip.
Well, first and foremost, bits and pieces just falls in line with a cost average strategy, and exactly when he posted this video, if you went all in, you'd be printing a heck of a lot more attendees than this guy was pushing in the right direction for, because that was like the max fear of the market, right? But the reason I'm showing this to you is because when someone's pushing a narrative that fits their circumstance, it's really easy to take contradictive statements from the best investors of all time, which historically all of them are underperforming the market. For example, let's say I'm an individual stock picker. I'm saying, yeah, I don't care, it's down 70%. I'm throwing all my money in here. You don't need to buy indexes. Index funds are for stupid people. But take a listen. I'd show you information like this.
We think diversification is, as practice generally, makes very little sense for anyone that knows what they're doing.
All that asset management, diversification, that's for idiots, right? Diversification, that's for idiots, right? Because you...
Now, take it to a flip 180. Let's say I'm a more astute investor and I'm like, no, you need to be buying index funds, global diversified indexes, and you need to cost average on a regular basis to avoid all risk in the market. And sure enough, I could show you the same investor saying stuff like this.
The best single thing you could have done was just buy an index fund.
If you're 21 and you put in $100 a month and you put it into a Vanguard index fund.
I'm big on diversification.
You're very big on diversification.
Like, knowing how to diversify well is more important than almost anything. People don't understand this.
It is super hard to find an analyst that does not have a contradictive statement over the history of their investing career. And damn, I don't know why you'd want to become a heart surgeon or an astronaut. Those things require damn near certainty. But an analyst, you get to manage tens of millions of dollars. You get to be involved with hedge funds. You get to be wrong all the freaking time. And you still make crazy tendies. It's kind of one of the craziest jobs I've ever seen. But I'm showing you this because I like one sentiment. One sentiment. I don't care if the markets are up, down, or all around. I'm going to be buying whether it's my favorite individual stocks or my index funds because I'm going to be bullish until the day I die, baby. Because inevitably I'm going to be right over the long term. It's how it's been since long before my inception on this planet. But if there's one guy that follows a very similar sentiment, of course, it's Tom Lee, right? You might remember this video from February.
The V for February is not Valentine's, but violent rally. And I think
one of my favorite statements, only to see the market sell off even more aggressively. But Tom Lee is back, baby, and he's giving us some more bullish sentiment. We're going to hear what his analysts think on the general market today, and just for fun and entertainment. Again, I would never take this as investing advice, but damn, I love my Tom Lee. So let's see what he's got to say.
Sarah, I think in the short term, I wouldn't be surprised if the markets pause a little bit, and that's something that our technician Mark Newton is calling for. But I think that there was a fundamental capitulation in June. Investors panicked, thought this inflation narrative was going to lead to years of pain. And I think that capitulation is now being unwound. So we think that the bottom is not only in, that you really want to be buying dips in the second half. And I think we'll be surprised at how much markets recover before year end.
Yeah, this kind of relates back to the psychology of that self-fulfilled prophecy where everyone gets so fearful we follow each other like lemmings off a cliff to the point where we end up losing money because the fundamentals aren't nearly as bad as everyone was projecting it to be. And now we're kind of getting this interim rally back. But it comes back to the point too, you don't know where the dip, everyone's like, oh, buy the dip, well, the dip keeps dipping or the dip doesn't come back to the recent dips we saw. You're kind of just stuck buying the rally. Just damn it, cost averaging, guys. Don't make rash decisions based off what these market cycles are doing.
Most of the strategists out there, Tom, they're not convinced. They say this is a bear market rally and the fundamentals point to a weakening economy. We heard it from Liz Ann Saunders at the top of the hour, a weakening economy. And even if we have seen peak inflation, it's not clear that the Fed is recognizing that or going to slow down anytime soon.
I love this term, weakening economy. Relative to what? Relative to the economy 6 months ago, 12 months ago? We step back 5-10 years in time and the GDP is a joke compared to even where it's currently sitting today. And yeah, we're seeing a slowdown in real estate pricing. The broader indexes have corrected 10 to 20%, but relative to what? 5 years ago, it's relatively still freaking high. And if you still believe we're heading into this technological revolution that has driven this value creation and it's going to make our lives better and easier and offer more value to companies, you know, from simplifying automation to genomics, all that stuff, guys, it should be relative that maybe 5 or 10 years from now, this isn't really a weak economy either. I don't know what we're basing relative economy weakness off of, but we'll keep going.
I think there's still a lot yet to be determined. And that's why when people are choosing how they come out, they're coming out bearish because the bearish narrative works better when you're uncertain. But if we have a softening economy, that doesn't mean we have a recession. We could just have a soft landing. Markets have not only rebounded and responded pretty well to inflation, but I think a lot of leading indicators for inflation are telling us that the hard data, like the CPI prints, aren't really reflective of underlying trends. Gasoline's a great example. You know, in July, gasoline might subtract 33 basis points from CPI, but on the current trajectory, it's going to subtract almost 80 basis points. So into August, I think inflationary deceleration pressures are accelerating. And then from a duration, I think people think this bear market's been too short. We're going to publish a piece tonight for our clients, but when you look at the duration of a bear market, it's typically 21% of the length of the prior bull market. This bear market has already been 146 days or 164 days. That's 25% of the prior bull. So we're already in the zone where a bear market could end. And we had that type of breadth thrust that took place. We wrote about how the percentage of stocks in bear markets was over 74%, really the fourth highest since in the last 30 years. The 3 other prior times it was this high, it was actually a bottom in the market.
Well, Tom Lee's given us a lot of fruitful information to wrap our ape brains around because we know how good he is at calling bottoms in the market. And if you'll excuse me here, folks, I am putting together some analytical research for a very important meeting that's coming up on why I'm going to take all of my friends and family's money. And we're basically just going to be dumping it into AMC and GME because ape braining has clearly outperformed the market this year. But on that note, stay cool, stay awesome. And as always, I look forward to catching you in the next one.